Welcome, everyone, and thank you so much for listening in. Today, we're going to talk about what is so important about earnings season. But before we do, as a reminder, this is an educational show and should not be construed as personal financial advice. Full disclosure information is available at ototnow.com. Now, let's get started. So, we are in the middle of earnings season right now. I recorded this at the end of July. And earnings season is the time of year when most publicly traded companies release their quarterly financial results. So usually it's the month following the end of the quarter. So in this case, the second quarter results, generally April 1st to June 30th, are now coming out at the end of July. So you can think each fiscal quarter. After that, then you have earnings subsequently later. Earnings season is generally about 6 weeks long. So when you think of all of the companies out there, there's about 6 weeks of earnings releases, depending on when everybody's ready. And then there's kind of a 6 week quiet period where you don't have any earnings or very few. And then it picks up again. So when you're in earnings season, you will see on most of the time increased volatility in the market due to the earnings that are coming out. These earnings allow you to reevaluate each stock in reference to their key performance and financial metrics that they had projected versus what they actually accomplished. So that's why it's so important that we pay attention to our investments during earnings season. So when you say earnings, it's talking about the after-tax net income, which, okay, let's just call it profits because that's easier to remember. But P&L, if you think of a profit and loss sheet, earnings is at the bottom. Revenue is at the top, right? Money coming in, that's all revenue. And then at the bottom is you have the profits. And again, it can be quarterly for earnings season, but also update the annual numbers. So you'll hear Q/Q, which is quarter over quarter. And then there's year over year. Or if you will think of like retail that has huge earnings in the fourth calendar quarter of every year because of Christmas, a lot more. Sometimes they will do, calendar quarter over calendar quarter, meaning instead of comparing it to the previous quarter, they're comparing it to previous Christmas season quarter. So you do need to know kind of what they're comparing, but things that have cyclical revenue and cyclical profits, of course, are compared that way. It's used to, again, assess a company's profitability. If there are no earnings, meaning it's not profitable, like Amazon was not for 19 years as it grew. Is it not profitable because it's not a good business model? Or is it not profitable because they're spending all the money that's coming in to grow? So they're turning around and investing that. So therefore, there are no profits because every dollar that comes in is turned back around to build the business. So you can't always tell from profitability. I used to, as an investor, shy away from companies that aren't profitable yet. But the lesson that Amazon taught me for the 19 years I wasn't in the stock, and I should have been, was that it was intentional and it was a choice, and they could have been profitable at any time. So something to think about out there. So you have earnings, and then the next thing you hear about is earnings per share. So that is simply if you take the total profits, total income, net income, total earnings divided by the number of common shares outstanding. And again, you have to be used, sometimes there's different share classes and things, but you have to know which shares they're being compared to, and then that's a ratio. So you have that earnings per share. Now what that does is it takes that number and makes it relative to all of the other numbers that are out there. So when you think of a market level earnings per share, you can say for a bank, maybe it's around 15 is the ratio. For a tech stock, it might be around 30. You look at the overall market, maybe 18 to 21. People will talk about the S&P being overpriced because it's a 25 PE ratio. So it helps make an apples to apples comparison in basically an apples to oranges world of trying to value all of the companies out there. So with earnings per shares, what you really need to look at is whether or not they beat earnings. That's an earnings beat, which means they beat for that quarter, they had $1 per share projected and they made $1.11 per share. That means they would beat earnings. Or they matched earnings, which, $1 per share, and they had $1 per share earnings. So, okay, that's matching. And then missing is they got less, right? They only had 90 cents a share when they expected $1 share versus what was being forecast. So that brings the forecasting into a piece of this. So far we've only talked about the earnings, but actually it's an earnings report. And there's several other things that go into that report. And we talked a little bit about, and coming out of these reports, stocks can move, double digits sometimes. When you have a big miss or a big beat, if you will, or we're coming, kind of out of this for the right now earnings. This is July 2020. The earnings are from April through June 2020, which is the height of the COVID season. Hopefully that was the height and we don't revisit that, but we don't know yet. But during that time, many companies adjusted for what they thought that quarter was going to look like. So there was an adjustment. But basically, if a company did really well and we didn't expect them to, or they didn't expect themselves to, that's when you can see a big earnings beat and a rise or drop, if it's the other way, of double digits percentages in a stock. And you can also get into where there's sympathetic moves. So if you use like McDonald's, for example, if McDonald's releases on Monday and Wendy's releases on Thursday, not endorsing these, I'm just saying for comparison, what can happen is on Monday when McDonald's beats earnings significantly and jumps maybe 15%, you'll see a like industry jump 10 to 12%, generally not more so than the company actually reporting their numbers, but it jumps in anticipation that on Thursday when Wendy's does actually release their earnings, most of that is already priced into the stock. So when you think of entirely for an earnings season like the one that we're in the middle of right now, earnings have gone pretty well so far, certainly against hugely negative expectations coming out of hopefully the worst of the COVID-19 quarters, is that can now subsequently keep that market going higher. And we've seen that lately. There's lots of negative headlines, but earnings have come in really pretty positive, and that's what's carrying not only the companies that have reported, but the companies that are yet to report can carry those names higher too in anticipation. So I mentioned that it's an earnings report, but there's other things included in it. So there's two backward-looking components, and then there's two forward-looking components. The two backward-looking components are the earnings that we already talked about, and that's bottom line guidance, because think of the P&L, profit and loss sheet, in your accounting class that you may or may not have remembered much from. But the top line is the revenue. So those are the backward-looking things. Those are actual factual numbers that have all the accounting's done on it in accordance with generally accepted accounting principles, and they'll say a company beat on the bottom and top and bottom line. That means they beat revenues and they beat their earnings. Again, those are backward looking. So the two things looking forward are the forward guidance and the conference call. So we'll talk about those specifically in order. The forward guidance first. The forward guidance now takes those numbers, because management knows the numbers from the previous quarter before they get out and have to announce them. And that's a quiet period, so they can't say anything for, I think, 6 weeks prior to earnings. It might be shorter than that. But the management now, once they know the earnings, they can look backwards and say, okay, this is how we thought we were going to do, and here's how we actually did. Here's what we already have out there for our projected earnings for the next 4 quarters or the next 4 years or both. And at that point, their forward guidance is now adjusting those metrics that they already have out there and adjusting them up or down. So you could see in a case that the company beats top line and bottom line, but yet guides down because they maybe are going to spend a lot of money revamping their business, because we're in a different world of the work from home economy. Or you could see them beat top line and bottom line handily and then guide up. And that's when you see, so when the numbers come out, the top and bottom line, yes, that's important, but there's really nothing more important to an investor than the forward guidance. Is what are they doing with their forward guidance? Now, and you wanted to see, if you're in the name, you want to see that that's good. If you're looking to get in a name, well, if it's good, you're going to pay more to get in that name. If it's bad, then you can assess why and see if you still want to get into the position. But it's basically management's narrative going forward in metrics, without words, just numbers. And that comes out with the earnings report. And then generally, About an hour, sometimes more, after the earnings report is when you'll have the conference call. Now, the conference calls are available to the public. They're attended by analysts who will sit and ask questions. They are often phone based, meaning the people aren't actually, even before we didn't have, before we could actually all get together, even though, sometimes the earnings calls were actually distributed. In other words, not everybody sitting in the same room. But you can always listen to the conference call by going to the company's website, go under investor relations, and then conference call, and there will be a link you click on and you can hear the audio. So some of them are televised, meaning there's a camera on them, but most are not. Most it's just the audio. And you'll hear generally some legalese up front and talking about, these are our best protections, and all of the compliance stuff up front. And then you get into, generally the CEO will speak first, give kind of or sometimes the CFO speaks first and talks some of the numbers, and then the CEO talks. But basically you have the C-suite there and available to give a presentation. There are generally slides associated with that end up on the website that you can take a look through to back up what they're talking about. And then at the end of their presentation, then that's when analysts can ask questions. Now, some of these can be fairly entertaining. Tesla with Elon Musk, he's a fairly entertaining individual. When he takes questions, he is merciless on the person asking a question. And if it's a stupid question, he will simply say, that's a stupid question, I'm not going to answer it. And then, the crowd goes wild, right? But for the most part, they're not quite that in your face. For the most part, any question that's pitched to them, whether it's kind of nonsensical or not, is answered by the appropriate C-suite executive that will address that call. And sometimes there's a handoff where the CFO will answer, a metric related question like earnings per share, and then the CEO will kind of piggyback onto that to provide some more to elaborate on that topic. So what I have seen, and where this is real world story, and this was back in Facebook, and it was 2012, and I remember it like it was yesterday. And Facebook IPO'd in 2012, it ran up big, then it kind of crashed, and that's when I set a price to enter, and I entered around that price, which turned out to be an epic entry. That was more luck than skill, I will just say that. And as it went up, it had doubled from there around to the $16 level, went up to 33. And they had a earnings release, and it was aftermarket. And I looked at all that, and I saw that the stock jumped, and it's like, fine, it went up to 33, and I sold my shares. I was like, well, that's kind of all I was looking for. As far as why I'd invested in it, and I got more than 100% return, so I was very pleased with that. And I was like, I think they're doing everything they're going to do, and I can use money elsewhere, because I don't really, I don't want to stay in the name forever, because I didn't have any idea of what Facebook would grow up to be at that point. Again, this is 8 years ago. Then during the conference call, which again was an hour after I sold my shares, and I listened to what Mark Zuckerberg was talking about. Now, he was very young and inexperienced, and some people say that he's still not very good at talking to the press, but he's supposed to go in front of Congress this week for not his first time, right? Several times. And maybe he's getting better, but the press doesn't cut him much slack. But listening to Mark Zuckerberg and what he was talking about and what Facebook was eventually going to grow up and be about, he laid out a vision. I will almost call it a 2.0, Facebook 2.0 kind of vision. And talking about connecting economies that, as long as they have, internet capable, even if Facebook, remember this is back in the days, they had a Facebook phone, I think, and there are some highfalutin things that didn't pan out, but just hearing the vision of how he could connect the world, and then subsequently how economies that were not connected could connect now and benefit several areas of the world that have not ever had this advantage before, and that Facebook was going to provide a lot of these things for free to be able to benefit from these small economies around the globe, that largely third world, that could now organize and make a better life for themselves. And I was just like, holy crap, that is a game changer. And as I started watching the stock, of course I have the stock pulled up as I'm listening to it, and the stock got up to 34, and I bought every single share back. And so when people think, and I held it for a long, long time. I didn't get out of it until I think it was 2018 or 19 when I started running into some bring privacy stuff. But then it was like 10 times the original what I bought it for back in the teens. But when you think about an investor, that's why this is so important. That's why I use this as the example is the numbers come through, but then you hear the leadership talk, and some leadership is very good at explaining what their company's doing and others are terrible at it, and the stock price drops every time they open their mouths. But that's what's so important about this conference call is you can really get a feel for your investments. Now, I don't expect everybody to listen to every conference call, and I don't have time to listen to every conference call that of a stock that I'm in, but I do for the major holdings, my top 10, as well as companies that I really am kind of on the, I don't know if I'm going to keep this company or not. It's like, all right, I'm going to listen to this call and see what leadership has to say. So that's the important part of earnings reports. Again, 2 backward looking, meaning the numbers, the top line and bottom line, revenue and earnings, and then 2 forward lookings, which is the forward metrics going forward and the conference call. So that's all I have for you today. Please reach out through ototnow.com with any questions or comments. Thanks again for listening in, and here's to you fighting the good fight every day to be on time, on target with your financial goals. Bye.